Welcome to this week's Money and Market Squawk Call, where we go around the horn with our editors to give you their insights on the happening in global markets for this week and beyond. Today is Tuesday, it's April 26th, and I'm Mike Bernick. Joining me today are Mike LARSON, Larry Edelson, Boris SCHLOSSBERG, David DUTKEWYCH, and MANDEEP. Morning, everybody. Go ahead and get started, I guess. The ECB met last week, decided to keep things unchanged, steady as they go. And this week we get to hear from the Federal Reserve tomorrow, as a matter of fact, after the two-day meeting ends Wednesday, and then the Bank of Japan's on deck right after that. Right now, according to futures markets, they assign pretty much a zero probability of a rate increase at this particular meeting and the next meeting, and only a 20% chance that the Fed will make a move in June. In fact, the betting now is that they may not make another rate increase until sometime at the end of the year. So, Mike LARSON, do you think that gives the Fed room, since the ECB's on hold, to perhaps go ahead and surprise markets and raise rates at some point, or does it really matter one way or the other in your mind?
Yeah, good morning. I really don't think the Fed's going to do anything this month. I think, regardless of whether they should have at some point done something more, they've kind of taken the dovish punt approach. And frankly, I don't really think it matters, because I think the U.S. economy is already tumbling towards recession, which is sort of an outside view. Everybody, all the Wall Street happy talk is about how the U.S. is doing great and everybody else overseas, that's where the problems are. But, just like even as we're doing this call, I'm sitting here watching the durable goods orders for March. They come in, they're stinking up the joint. The orders for the entire first quarter have stunk. Retail sales have stunk. Across the board, GDP looks like it's going to come in very close to zero for the first quarter. There's an outside chance it could even be negative. Everybody's saying, oh, it's all foreign, it's all foreign. That's just not true. The U.S. economy, I think at this point, is starting to stumble, and I think we're going to see increasingly the next domino to fall is going to be in the jobs figures, which are going to play catch down to what's happening with layoffs already. And I think that, the U.S. economic outlook to me is a lot grimmer than is generally appreciated on Wall Street. And I think another part of that, whether it's sectors like real estate, commercial real estate cycle appears to be topping out. Residential is not the locus or the central part of the problems that we're facing today like it was in 2005, 2006. But even there, we're seeing some lost momentum. New home sales just fell for the third month in a row. Prices were actually down on a year-over-year basis. So not some huge bubble bursting on the residential side. It's actually more on commercial side this time, where we saw absolutely ridiculously stupid valuations for commercial real estate. A lot of big, dumb money coming from overseas, buying into U.S. property at insane valuations. And, now you're seeing the amount of space available for lease rise. You're seeing the absorption of existing space, net absorption go down. Rent growth is starting to top out in many markets. And I think that, of all subsectors, apartments look the worst, because that's where we've seen a huge amount of construction of apartments, particularly at the high end. Rentals, almost every building downtown is being converted from old, around the country, from old warehouses and old office properties into sort of designer condos and things like that. And so that's kind of been where the activity boom has been, and where I think a lot of the fallout is going to be the worst. So, to sum it all up, I don't really care at this point what the Fed does. I think, there's this unhealthy obsession with central banks and even with oil prices, when behind the scenes you have sort of these topping out bubble pops, whatever you want to call it, in everything from commercial real estate to autos to stock, debt-funded stock buybacks to IPOs to private equity and on and on. So that's the real story to me, is that there's a lot more going on than oil, and there's a lot more going on than central banks, and the market's going to wake up to that fact pretty quick. And I think that's why you have to be pretty darn cautious here. There's a few, less non-economically sensitive, safe yield kind of plays that are okay to invest in, I think. But I think a lot of this, this deep cyclical, economically sensitive bank-type buying that I've seen, I think it's just at the absolute wrong point in the cycle, and I don't want to have anything to do with it. So that's my take.
All right, Mike, thanks.
Thank you.
Caution is the watchword. Certainly, we've seen, a lot of perhaps angst in the market, a lot of anxiety on the part of investors, and yet we're back above 18,000 on the Dow last week. Larry Edelson, what do you make of that disconnect with the markets doing so well and people feeling so crappy about it right now?
Well, I don't think it's a disconnect at all. I think it's a complete 100% connection. again, I've been saying this for 2 years now. It's not Fed money policy or ECB policy that's pushed Dow stocks up. What's pushed Dow stocks up is that of the three major economies in the world, Europe, Japan, and the United States, we're the safest, we're the strongest, and we're in the best shape. So, and we don't have negative rates, at least not yet. So you have to be really pretty much an imbecile to have money in Europe or Japan, and you got to put, if you have any sense of protecting and growing your money, you want it in the U.S. dollar and in the U.S. economy. So that's why you're seeing this separation between the blue chips and the internals of the Dow and the S&P 500. We have a hidden stealth bear market going on in the U.S. markets. But it's no surprise to me that there's a disconnect, if you will, between the Dow and the S&P 500 and, the U.S. economy, which is, granted, it's not firing on all 8 cylinders or even 6 cylinders and maybe not even on 4 cylinders. But it's firing better than Europe is, and it's firing better than Japan is. And geopolitically, it is a safer place to put your money, even with Donald Trump spouting out how what's his name stuffs pancakes down his face. I mean, you got to look at this from geopolitical. And if you think it's bad now, I can guarantee you 4 to 5 years from now, it's going to knock your socks off when you see the Dow at 30 to 33,000, and the U.S. economy is truly back in a very deep recession, along with the rest of the world, and our stock market is doubling and tripling.
What's your take on?
I know it makes no sense, but you got to look back at history. The last time anything remotely close to what's happening now happened was the Great Depression. And if you read the annals of the Great Depression and the parts of the Great Depression that nobody ever tells you about, you'll see what I'm talking about. So
Larry,
I don't think it's a disconnect at all.
What's your take on some of the other markets, particularly the dollar and gold?
They're all bottoming. On a longer-term basis. Gold is going to pull back, still pulling back probably to just below 1,200. 1180 to 1160 is my target. Then we'll begin a third leg up, if you will, or a second major leg up, if you will, leg 3 in LA wave terms, if that's your shtick. Pretty much same thing with many other commodities. Copper's looking good, oil's looking great. 52 to 55 should be only 4 to 6 weeks away. Grain markets are starting to look good. Dollar is, dollar, if you look at the dollar, all it's been in is a fourth wave triangle from its big rally earlier this year and last year. And that triangle is a sloppy, choppy triangle, but it's going to resolve to the upside with another big push to the upside, which should occur very soon. So the dollar remains very, very strong. Deflation is still the main topic. That's why you're seeing so much talk about negative rates still across the world, even in Washington. They think they can cure deflation with negative rates, and they're absolutely, totally, 100% wrong on that. And they're, just going to set out on destroying the monetary system, which goes hand in hand with policy making and fighting deflation. So, come the end of this crisis, somewhere around 2020, 2021, when it gets really bad, we will be seeing the monetary system completely crash and burn. And that's when we'll get the monetary revolution.
All right, thanks, Larry. Appreciate it. Let's see, Boris SCHLOSSBERG. We've certainly seen a lot of volatility in some of the currency markets recently with the zero interest rate experiment underway in both Europe and Japan. What do you make of the moves we've seen here recently?
Well, I have a little bit of a different view, I think, driven primarily by rates as to why equities, for example, are doing so well. There's two reasons why, even though we have a slowing economic environment, and so far we have a slowing economic environment, we're not anywhere close to a recessionary contraction at this point. The first reason is that relative to bonds, even in a slow growth environment, stocks are still, you have basically multiple expansion because the lower interest rates are, the wider you can have multiple expansion in order to offset the very low yield of rates. The second thing is that stocks have become yield substitutes. The dividend yield on the S&P 500 is larger than the yield on the 10-year. The one thing that is kind of interesting that I'm seeing this week, and you can always change tomorrow. Tomorrow really is a big day because we'll have to see what the Fed says. But what's interesting is that despite all the doom and gloom and the fact that everybody is very negative and dovish the Fed and thinks that the Fed is really not going to do anything, the 10-year this whole week has had a much more positive tenor. It was as low as 175 just a week ago. It's now trading 191. Fixed income market is always, to me, the most intelligent market in the world. If they're bidding up rates, maybe there is a more positive tenor to the dollar, and maybe there is a slightly less dovish outlook for the Fed. Hard to say. I mean, I think everybody else has pointed out that the fundamentals have certainly slowed over the last couple of months. It's difficult to make the argument that full speed ahead towards rate hikes. But I think the other aspect of it is that the Fed really wants to keep its credibility alive. So they may communicate a more hawkish posture tomorrow. And in that case, you can see dollar yen, come up. Or it's already come up quite a lot off the bottom. Come up a little bit further towards the 112, 113 level. And the other big story in the currency market, which is a side story, but it's been fascinating, is this whole Brexit story. The idea that UK was going to spin out of the European Union was really taken seriously as recently as just even a couple of weeks ago. But over the past few weeks, everybody has really beaten up on the Brits to tell them that if they spin out of the Union, they're going to basically lose 10% of their GDP. And yesterday, President Obama went on television and basically said that if the Brits decide to leave the EU, it's going to take 10 years to negotiate a bilateral trade deal, just another form of jawboning. So as a result of this, the Remain vote is now firmly in the lead. But the one thing that I caution, this is the one thing that I sort of always remember from political pollsters, is that when people have a referendum in front of them that is politically incorrect, where the Leave vote, for example, is not the conventional consensus idea, they will very often lie to the pollsters. And I wonder if the whole Brexit situation is much more fraught with danger than the market currently thinks. British pound has just soared on the idea that this is a no-go, but it could very well be just a shock to the system. In fact, it could be a really big shock to the system globally if UK surprises and votes for Brexit. So I think that's one of those risks we need to keep an eye on over the next 6 to 7 weeks, because I don't think it's quite over just yet.
Absolutely. Definitely something that'll be with us as we move into the summer. Thanks, Boris. I appreciate it. Let's see, David DUTKEWYCH, what's your take on some of the volatility we've seen in markets here recently?
Hey, everyone. Thanks, Mike. Well, that's interesting. When you mentioned volatility, it's really still hasn't gone anywhere. The markets are still up near their highs, and volatility is still really down near its lows for the year, with the VIX index only at a little over 14 right now. I do think we will start to see that rise as we get in with the Fed meeting. There's a lot of economic news besides the Fed this week. We also have Japan coming out as well, as you mentioned earlier. So I do think we're going to see volatility pick up here. So the markets, are at a critical point right now. So it's going to be interesting to see how far we can rally if we do get a more positive economic outlook, or if we start to see, as Mike mentioned earlier, some more negative news coming out, economic news. We could see still a decent pullback. There's a lot of support on the downside because now that we've run up so much, back down to that 2015, 2000 level, and then maybe even down to 1950. So if we do get some negative news, I do think we should be able to pull back into that range, but I do think we might be able to hold there as well. So I don't think we'd have anything significant at this point. Gold's been in a trading range right now. It hasn't been able to break to a new high above that 1287 level, and it really hasn't been able to break down much, kind of been holding around 1225 to the 1210 level. So we've been in that range right now. We're about 1235. So we're really holding in this range right now. I think, if we do get a little bit of a surprise, as Boris mentioned, or not a surprise, but a more hawkish tone from the Fed statement coming out, I do think that maybe will push the dollar higher, and I do think we'll see gold push to that bottom end of the range, probably down closer to Larry's numbers, where we do see maybe the 1,200 level break and get down to that, 1180, 1188 level, somewhere in that range. And then that may be a time where you can start to jump back in. The oil markets, the energy markets, natural gas is still holding up well. Oil itself is holding up well at around 43. I do think that could push higher here as well. They may get a little bit of a pullback if we do see some strength in the dollar. But again, I still think we're holding strong in those markets. The grain markets, Larry mentioned briefly, and it's been an interesting market there. We saw them really break out last week, and they have come back in for over the last few days, but they're still holding right now. We see soybeans and corn, they're holding right above their 200-day moving average. We can kind of hold these levels here. We might have a good time to be able to go along in some of those markets.
All right, so the grains could be a good opportunity. Thanks, David. Appreciate it. MANDEEP, why don't you give us your take on the markets?
Hey, good morning, Mike. Good morning, everybody. Excuse me. So the market's just kind of grinding higher here. It's already been mentioned we're at critical resistance points. The earnings function out of the S&P 500 have been slow, and many companies, just as many companies, have reported positive as a negative guidance. So far, we're down 8.9% this quarter on a blended basis, and that's kind of combining companies that have actually reported and those and the expectations for those that haven't reported. So that's almost a 9% decline. 76% of the companies so far that have reported have beat their lowered expectations. But interestingly, the margin of the beat has been the slowest versus 10-year averages. So we're, despite being very, very low in terms of expectations, I think we came in with expectations of a 9% decline. We're only marginally beating those expectations. Tech stocks were the latest to miss. We saw Alphabet, Microsoft falling on Friday. We have Apple and Twitter reporting tonight. Apple's going to be interesting. Facebook tomorrow. Amazon on Thursday. So these are the larger companies that have the potential to have ripple effects through their industries and in turn the overall market in sympathy. So watch them. Expectations have been very low, so a beat could be possible, especially for Apple, which has been getting dogged recently regarding their iPhone sales. And they're expected to show the first decline in earnings in numerous quarters, and they're expected to be a drag on the S&P sector. So in terms of the overall market, yes, I agree with Boris. With the alternatives being very, very low in terms of bond yields, there is an opportunity for multiple expansion. We're at 17 times forward earnings here. We're the top end of the range, for the S&P 500. And that's coming in conjunction with an earnings decline, the fourth consecutive decline in the last 4 quarters. So that's kind of problematic because the market is, I agree that we are facing, the substitution is there in terms of, transfer into equities or riskier assets because of the yields, but the earnings have not been being produced by these corporations. Now the commodity rally has helped, especially namely in oil, has helped future earnings expectations. So the market's discounting more into the future. So it'll be interesting to see what oil does. But the frothiness or the risk in the market has been kind of played in, especially with the expectations for rate increases coming later rather than sooner. We'll get more out of the Fed tomorrow, and we'll see if Janet Yellen can kind of give the market the impetus to rise to all-time new highs, even though the Dow had done a new high last week. The rest of the indexes did not follow. So that's going to be interesting to watch. In terms of our portfolio, these levels, I'm still a better seller, and the reason is that the risk-reward ratios are not as encouraging. I'll hold my hedges until we get a breakout across these various indexes. And until then, I think looking for a 50% retracement of the recent rally, and if economic fundamentals are still okay and we're not going to recession, that would kind of prompt me to ease up on my hedges and adding high quality long exposure. I do think that the market in the economy in general has been softer, especially in what relates to the consumer auto sales, home sales. Mike has already mentioned durable goods orders this morning were a miss. We're looking for 1.8% growth. We actually got like 0.8% growth. So these are all kind of cautious numbers. It's not telling me that the market rally is footed on strong fundamentals for economic fundamentals. And you have central banks across the globe that are buying assets, propping up, trying to devalue currencies and so forth, and all of that hasn't really materialized into much growth. And now we're talking about going negative. Some of these economies already have gone negative, and that's kind of problematic because I see long-term and short-term debt cycles. And this could be the last leg of a long-term debt cycle, which is kind of transferred from the consumer now to the government that's been borrowing and racking up debt. And then, in a low-growth environment, if they can't manufacture or engineer this growth, that's going to have to be contended with someday, and we're potentially just pushing that, kicking that can down the road. Really quickly, Unilever. Large, high-grade British and Dutch company issued debt. I believe yesterday that's maturing in 4 years with a 0% coupon, and it's because the ECB is going to be buying high-grade corporate debt, and that debt is going to be yielding absolutely nothing. And this low cost of borrowing is problematic because it induces financial engineering. What are they going to do? They buy back shares. They're going to be increasing dividends. They're not likely going to be investing in growth-oriented projects. They're not going to be spending on capex. They're not looking to enter new markets and things like that. But it does induce risky behavior. So these sorts of types of things is not exactly what you want to see. This money going towards. And in terms of the consumer, negative interest rates, what incentive do you have to keep your money in the system? You're more likely to take that liquidity out, stash it under your mattress, and you don't want to be paying for deposits. You don't want to be paying the banks for holding your money. Less money in circulation means less money that's being spent, so it has the negative effect on the overall economies in which those consumers live. So there's a lot of stuff that's going on here, and for that reason, as I mentioned at the top of the call, I'm a better seller at current, but I can't ignore what the market's telling me. So if we do get a breakout, I'll be opportunistic and get into more long exposure. But obviously, again, caution and is the operative word here.
Indeed it is. All right, thanks, Mandeep.
You got it.
Appreciate your comments. Well, that wraps things up for this week's Squawk Call. Great insights, gentlemen. Thank you, one and all. And be sure to tune in again next week. Until then, I'm Mike Bernick for Money and Markets. Good investing.